Hey guys, it's Will. In this video, I'm going to share with you how to get started as an investor that's a beginner. And I'm going to use all the questions that my wife has given me about how to get started investing and bring them straight to you so you don't have to spend so much time figuring it out. The first thing you're going to do is find your brokerage. This is going to be the place where you invest and buy and sell stocks or buy them for the long term. I'm going to include a screenshot on the screen. It's going to show you the best brokerages for long-term holding and the best brokerages for short-term holding wherever you may be in the world. Now, when it comes to choosing your long-term investments, I like to use a brokerage that's not so easily accessible or tempting me to want to buy and sell stocks a lot. Some of the newer brokerages are designed to be super engaging. For example, Robinhood, I like it for short-term investing, but when it comes to my long-term investing, I want companies or brokerages that aren't so easily tradable and that I would have to maybe log in on a computer, or it's not going to be very good for short-term trading, so that I don't touch my long-term investments. So for long-term investments, I use Schwab and Vanguard. Now you can use any brokerage that works for you, but that's how I've set it up. If you're going to be investing for the long term, which is a good strategy is to have long-term and short-term investing, the first step is going to be choosing an account that you won't get taxed on that money when you pull it out when you retire. So the best account to use for that is going to be called a Roth IRA, which is going to allow you to contribute money every year, about $6,500, and not be taxed on that money when you pull it out along with retirement. So investing a couple $1,000s a year consistently, by the time you're 65, you will retire with most likely millions of dollars in your bank if it's compounding at the rate that most stock investments do if you're investing in the S&P 500 at about 10% per year. But who wants to wait until they're 65 to make their money or touch their money? A really good way to invest is to not only have your long-term investments that you can have a nest egg building up over time, but also the step number 2, have something set up for your short-term trading. Short-term trading isn't hype stocks or what all the YouTubers are talking about are telling you to buy, that if you don't buy it, you're going to go broke or lose all your money or what have you. These are the short-term trades, companies that are intrinsically valuable and have integrity, and companies that you would probably already want to invest in for the long term. You're just taking advantage of some of those short-term dips that always seem to show up. So this brings us to step number 3 when investing, which is I don't invest in any stocks personally that I wouldn't want to hold for a couple of years. By doing this, you make sure you're not holding companies that you don't understand, that you don't like, that are emotionally attached for you, that you don't really have any strong conviction behind. And if it dips down, you'll end up selling or not managing your portfolio correctly. You want to buy companies that aren't hyped up on YouTube, that aren't everybody's telling you to buy them before it's too late, but are companies that most likely meet this 7-step criteria. Now, this is the criteria we use in Stockmates, which is where if you're looking at short-term trading, we go live every day at market open at 6:30 a.m. If you ever want to watch our daily live trading sessions, it's the second link in the description. But let's jump into it. The first step is validating your market. So validating your market means this step is going to include that there's profits, that there's revenue, that there's a lot of money from big institutions that are going into that stock. And the best website that I use to verify if they're getting a lot of profits is called NASDAQ. You can just go to NASDAQ, search up the stock that you're looking at, any company, and it will tell you the different institutions that are investing in the company. This step is crucial because it allows you to know that there's real money going into that market and it's continuing to grow year over year. So searching the annual growth rate of that market you're investing in. So for example, energy or AI or data centers or space tech or construction or what have you. Search up, what is the annual growth rate of that market? The second step, which is still in the category of market and analyzation, is going to be that there's real world usage. So you've probably heard the best stocks to invest in are the ones that you use, whether it's, the Apple iPhone, or you see the truck of the brand, the Ford truck in front of you, or it's, in this case, a MacBook, or I don't know, there's a TV behind me that's probably Toshiba. If there's something that you're using a lot and you like that product, being able to verify that there's real world usage, that it's actually tangible and you can see it. A good example is Starlink. You can't invest in the company because it's private, but we could see the constellations of the satellites flying over. And so I searched, what companies are providing the microchips for those Starlink satellites that we could see fly over here in California. And the answer was AMD stock. And AMD has been a really great investment as a result. Another good example of real world value is to search up a company, let's say Tesla stock, and you ask yourself, what company is providing the microchips for Tesla, or what company is doing the manufacturing materials for Tesla? And then you could now find that company, and that might be a good investment for you. The third step brings us out of the market analyzation. So this applies to your short-term investing, your trading, which we can get into in depth later in the video, or your long-term investing. And the long-term investing and short-term investing congruency, that they're both companies you'd want to buy for a long time, is important, which brings us step number 3 again, which is your analyzation steps. So the first analyzation step is going to be looking at the chart. So when we look at charts, a good example of what we'll look for are things like support and resistance. We look at things like, and this is something I can show you, indicators that tell us when a stock is oversold, meaning it has a higher chance of potentially bouncing and going up, or when a stock is overbought, when it might be a good time to sell. So a good example here is if I'm opened up, in this case, we're looking at the chart on Robinhood. You can look on any platform. Let's say we're looking at Google stock right now. We might look at Google stock and we could see it was at a support level, in this consistent uptrend that we've seen with the stock. It has this rising support. So the technicals would show us we're in this uptrend. When it sold off down to this level, you could see there's a few indicators. Number one, it's near this support, around this support level where it would be considered more of a buy. The other thing to consider is this RSI here. The RSI indicator is indicating a buy. It's low. It's below this 30 frame. If it was up here, it would indicate a sell. So a good example is up here. You can see RSI indicating a sell. This is a sell. Down here was more of a buy on the RSI, and you can see that correlates with the chart very well. And the MACD is the same thing. So we use a lot of indicators like that. So just familiarizing yourself with indicators can help with the technical analysis. Some of the top technical analysis things we do is we use the support, the resistance, along with the value trends. So the second step in your analyzation stage is going to be looking at the financials of a company. So let's take a company like, let's see, there's a drone stock that has been getting a lot of attention that we could look at. We saw some ads for recently, which is called Red Cats. But let's see, maybe there's another one. There's quantum computing. What would be a good one to look at? We're going to look, this is a company that builds data centers. So we've probably gone through our market. We say, oh, data centers are getting built for big tech. So that's a good market to be looking at. We see the revenues increasing. We see the real world usage. And that, with ChatGPT, or you're using ChatGPT, or you see people using AI. So data centers are a good market to look at. So we get through the chart. Maybe we've looked at the chart. It looks good. Now we look at the revenue. So the revenue is going to basically tell us their growth year over year. So I like to use something like Google Finance. You can go to Google Finance, or if you're feeling like you really want some good analysis, you could go to the first link in the description. This is a software I've put together with my team that gives you not just projections for the future, but also financials. It's called Mercatus. It's a machine for your analysis. It's the first link below. But essentially, imagine we're looking at the financials for Applied Digital here. Now, if we're looking at the financials, we want to see the revenue is increasing year over year. In this case, it is. Looks pretty good. But the other thing we want to watch is the net income. If net income is negative, that means that they've spent more money than what they had in revenue. So in this case, we had some instances where their revenue was or their net income was negative. And what you want to do then is whatever you see in the income statement, you're going to want to look for increasing revenues. Net income is important. We want to know they're making money. But what's going to be more important than net income, if they're in a startup phase, is to look at their balance sheet. do they have more assets than they do liabilities? And in this case, this company is growing their assets. So we go to the balance sheet, we could see their assets and see they're increasing. So really, you could just do a Google search. You could say, what is the balance sheet of this company? And it will tell you how many assets they have and how many liabilities. If a company has more liabilities than they have assets, then that means that they are on the brink of what could be bankruptcy. So you don't want to invest in companies that have more liabilities than assets. It just means that if those banks or institutions want those debts to be paid at any time, they aren't going to have the assets to be able to liquidate and pay those liabilities. So in this case, we see their assets are increasing and it looks good. Now, the PE ratio you want to look for in the financials, it's going to be usually, at least Warren Buffett looks for, a PE ratio of about 20. Now, we can't see the PE ratio on this company, but that's okay. We could see that on most companies. You just search the PE ratio of them and you can look for a PE ratio. The higher the PE ratio, the maybe further off they are from being their true value, and that they could be a little overvalued. But if PE ratio is lower, then they could be potentially undervalued. So then we get to step number 4, which is going to be the news. So we get to the news. For example, Applied Digital. This is a company that builds data centers. We want to look for things like contracts, new product developments, things that we know are going to increase their revenue and grow them. Just good news, basically. And if it's bad news, that could help us make a decision on something that we wouldn't want to invest in. And so Applied Digital, and this is the other thing to look at for news. Don't go to what Fox News says. Don't go to what CNBC says. Don't go to what all the mainstream media says. Go directly to the source of the company that you're looking for news from. Almost always they release news articles. And so if you want to know news about a company, they'll tell you, just go to the source and don't allow yourself to get manipulated by big media or different YouTubers or different people that are telling you what is happening with the stock if you can't verify it from the company themselves. So when you look at the news, the other thing that contributes to good news is their partnerships. We could see this company is building data centers, point of generation with solar power or wind turbines, and they're building it in cold places like North Dakota. They work with Supermicro Computer. We know that's a company in data centers, which is a good partnership. They work with NVIDIA, which is a good partnership. That's the top company in the world for AI. Dell Technologies, Intel, Hewlett Packard. So we see good partnerships. So that gives us good indication that this is a good deal. So from the news perspective. So there's 3 pieces to the analysis in the analysis stage. The first is the chart, which we kind of go over. The second is going to be learning how to look at the financials. So that's the income statement, the balance sheet, and things like that. And then the fourth step there, or I guess the 5th step there, was the news. So that was the 5th step. The 6th step in our 7-step process is identifying the risk. So we're going to look at a company like Google, for example. If we're looking at Google, we've seen them, have some pullbacks. Let's say they're at an all-time high. We could look at technicals or fundamentals to identify what is the potential risk. So if their PE ratio is high, maybe that means there's more risk. If they're at a resistance level, like in this case, maybe we could see Google sell back down into levels of previous support. Maybe not as far as it was back in April, because that was a greater market sell-off, but you want to look for the risk. So is there more risk here than there is what will bring us to number 7, which is reward? So let's jump into the same stock, APLD. When we're looking at APLD and we're looking at their trend that they had here, let's see where it looks at. You can see the RSI looking a little overbought at the moment, the MACD looking a little overbought at the moment, and maybe they sell back down to this level. Now, one thing to note about previous resistances is that previous resistance can oftentimes act as a support. So that would be the next level that would potentially act as a support for them. Right now is around that $13.50 to $14 range. It's kind of watching those levels. Now, it's really important to realize that your risk tolerance is more important to gauge for your shorter term trades, because shorter term trades usually mean that you're going for a margin or a risk that you set to a reward that you set. So for long-term investments, ideally you buy it and you hold it and you don't touch it, and you continue to just hold as many shares as you can so that they go up in value, and later on your portfolio becomes very large if it's not already large, and then you can then take out loans against those stocks and use those stocks to now buy more assets, and those loans are money you can take out tax-free because they're loans. There's things like that where holding stocks are really a big advantage for the long term. But if you're looking for a short-term trade, which is what we do as well, we're looking for a margin for profit of a minimum of about 10% to 50% margin for profit. And what does that mean? Well, that means we're looking for the stock to basically rise that much or indicate that it's going to rise that much. So maybe with APLD, we see a sell down in this range. We would look for a buy around this previous resistance, a support, to make that 30 to 50% or 10 to 50%. Now, why is it 10%? Because in shorter term trades, we don't go lower than 10%, because if you go lower than 10% margin for profit, what that means is now we also have our risk mapped out. So with a 10% minimum, we're willing to risk 2%. So we would have a stop loss in from our entry of where we buy about 2% below that. And I have a profit calculator you can download for free. You can grab it. It's in the third link in the description below. This is something we use quite often. It's a stock profit calculator. So for example, let's say that we're buying this stock APLD at $13.50 and we've waited for it to hit that support. $13.50 is the purchase price. Let's say the current price, it's gone up to $13.60, and let's just say that we have, I don't know, 1,000 shares. Now, if we're looking for 10% margin for profit here that I can adjust up, and you can see down here we're going for 10% margin for profit. That's going to be what will be a sell price of $14.81. So we would look for it to get up into $14.81 right here, about a 10% margin. And we're going to look for that risk now. Where do we set a stop loss? So we don't want to lose 10% to gain 10%, because that means we are going to, if we lose more than one trade in a row, we're really negative. We want to set a risk that we could lose trades and still be able to make a profit so long as we win a trade every 3 times or 4 times. And so in this case, 10% margin for profit means we set our stop loss at 2%. So we'd set a stop loss at $13.24, which would be significantly lower to where we entered at 2%. Now the beauty is, if we increase the margin for profit we're going for, let's say we're going for now 15%. Now we increase our stop loss to a risk tolerance of -3%. And so basically you could go up 100x, 10x the amount that you buy for very long-term investments. So that's why you never set a stop loss on long-term investments. You just continue to hold long-term investments. But for the short-term trades, you want to set a stop loss at a level that if you lose, it's okay, because in the long term, even if you lose more than you win, you're looking for a reward that is 3, 5, 10 times bigger than that of your risk, so you can afford to lose. So those are the 7 steps. The first step, the market analyzation of the profits and the revenue. The second step, the market real world usage, that you see that it's being used in the real world. The second step is going to be that you identify the analysis. So the analysis would be the technicals. Then the fourth step would be looking at the financials. The fifth step is looking at the news of the company and what they're doing, their products, their developments. The sixth step is looking at the risk that you would take on if you're doing a short-term trade or even a long-term trade, looking at the risk that you take on to where it's at, to where it could potentially go, and then the reward to where it's at, to where it could potentially go, that is much greater than that of your risk. And if you do those 7 things as a beginner, then you're going to be on a great track to continue to grow your brokerage accounts and build the dream that you're looking for of making money work for you, and build the freedom into your life that could pay for your everyday expenses and things like that. So hopefully you guys enjoyed. For those of you guys that I earned it from, hit that like button. If you want to join us in our daily live trading sessions or check out that machine for AI predictive analysis, you can check out that first link for the machine, the second link for every single morning, Monday through Friday at 6:30 a.m. Pacific time. We go live, and you also get a bunch of lessons on technical and fundamental analysis, as well as a free t-shirt that I'll send to you anywhere in the world. You get a cool StockMate t-shirt sent over to you. But ultimately, you get access, lifetime access to those live sessions. And those live sessions are recurring, so you get lifetime access, but that lifetime access is going away soon here on September 1st. So if you want to not pay a subscription or have to, pay a monthly fee or anything like that and get lifetime access, it's the second link in the description below. Thank you guys so much for watching. Appreciate you all. Do consider subscribing, and I'll see you in the next video. Take care.